Welcome back to Father and Son Investing. Today we're going to be talking about the I-bond fixed rate. There are some things I think that we all need to understand about the fixed rate before you go buying more I-bonds with this new fixed rate. You may have heard over the weekend the new fixed rate is 0.9%. Today we're going to talk about the things you need to know about the I-bond fixed rate. Number one, we're going to answer the question, isn't the I-bond fixed rate a guaranteed minimum for my I-bond? Then we're going to follow up that question to say, if it's not, what are the chances that the next I-bond interest rate that you receive on a bond you purchase now or when you've already purchased will be 0% for 6 months? And lastly, I'm going to discuss whether we should buy I-bonds now with this nice 0.9% fixed rate, or should we wait and perhaps hold out for something better? Let's get to it. All right, item number one. What is it that you need to understand about the I-bond fixed rate? There's a lot of confusion out there about this, and I get questions frequently about why someone's I-bond isn't earning what they think it should be earning, and it's usually because they have a different fixed rate than the current fixed rate. So the way the I-bond works is when you purchase your I-bond, it comes with a fixed rate. That means it is fixed for the life of the bond, 30 years if you choose to hold your I-bond that long. Every 6 months, the I-bond fixed rate changes. The I-bond fixed rate for your bond does not change, though. It remains the same for the life of your bond. Therefore, when you hear the current advertisement saying that Series I bonds are 4.3%, you need to realize that that includes a fixed rate of 0.9%, but your I-bond may not have that same fixed rate. And therefore, you need to take what the variable rate is and add your I-bond fixed rate to it to figure out what you are receiving. Now, you can do the math on that if you like, or you can just turn to this nice chart that the Treasury has developed for all of us. I will leave a link to this chart in the notes below. All you need to do is take the issue date when you purchased your I-bond in this first column, and if you go to the current time, you will see what your I-bond is earning. For instance, if I purchased my I-bond in between November and April of 2022, I had a fixed rate of 0.0%, and therefore my I-bond is earning 3.38%. This chart is actually fantastic to figure out what it is that your I-bond is earning, and we're actually going to refer back to it in just a little bit. Hopefully that discussion clears up any confusion you might have about the I-bond fixed rate. If you still have questions though, feel free to leave them below. I will do my best to answer them. Let's move on to item number two. Isn't the I-bond fixed rate a minimum guarantee? If I have an I-bond that has a fixed rate of 0.9%, such as the ones that you can purchase now starting yesterday, doesn't that guarantee me that I'll always get at least 0.9%? Well, if you're thinking that, I hate to disappoint you. The answer to that is no, and let me give you the scenario where that can happen. To explain this, we're going to turn to just a little bit of math. Sorry, but you need to understand how your rate on your I-bond is calculated. First of all, there is this fixed rate that gets set. Second of all, they come up with what the semi-annual inflation rate is. I'm not going to belabor how that gets calculated. I've done that in other videos if you want to refer back to that. The current semi-annual inflation rate is 1.69%. To come up with an annualized rate, because that's what they quote, 4.3% is an annualized rate. Your I-bond will not actually earn 4.3% during those 6 months. It's going to earn half of that. But to come up with an annualized rate, we're going to double what the semi-annual inflation rate is. So that's where 2 times the semi-annual inflation rate is. And then they also take that fixed rate and multiply it by the semi-annual inflation rate. You can see those numbers are pretty small, and it adds just a tiny little bit extra to your I-bond. Adding up all of those parts, they come up with this number here. They round to 0.043, and thus you get 4.3%. That's how it's calculated. Now, hopefully you're seeing here, if this number here in the middle turns negative by more than what the fixed rate is, you could see that you could actually come up with a negative number down here. Say that the inflation rate turns to minus 2%. Obviously that overcomes the 0.9% and you end up with a negative number down here. Now, the Treasury is kind enough not to take money from your I bond. They just make the yield 0% should this instance happen. So the answer to the question, isn't my I bond fixed rate a minimum guarantee? The answer is no. Your actual minimum guarantee is 0%. To illustrate how this works, we're going to turn back in time. There are a couple of instances where this has happened. We're going to go particularly to this May 2009. In May 2009, the inflation rate was negative 2.78%. And if you look to see what the I bonds paid out, you will see that all of them say 0% on their yield. Every single I bond that was out, the inflation rate had overcome whatever their fixed rate was, 0%. With those 2 points as a basis, let's just turn to the next question. And the question is, what are the chances that my I bond interest rate come November 1st will become 0%? I'm talking about bonds that people already own or that they will buy between now and November 1st. Now, I don't have a crystal ball and I don't know all, but I do know one important thing, and that is that the majority of the CPI, that is how your variable rate on your I bond interest gets calculated, the Consumer Price Index or CPI, the majority weight in there is housing. Let me show you what I'm talking about. I love Investopedia. It's a great site to get some really basic information, and they do a great job of explaining things. We're going to use this graphic here from Investopedia so that you understand there are 8 major groups in the Consumer Price Index, one of which is housing. This pie here makes it look as if they're all weighted the same, but that is not the case. In fact, if we turn to the latest weighting data here, so March of 2023, housing takes up 34.5%. So it gets the majority of that piece of pie, in fact, about 1/3 of it. With that in mind, I want to show you this graph. I've actually showed this in other videos, but it's important for this video. You need to understand that the way that the Consumer Price Index measures housing has a significant lag, meaning while they may say that housing prices are going up, in this case we're looking at PCE, but they measure similarly. This red line here shows that what looks like housing prices are going up. The real-time data that you can get from other sources such as Zillow and CoreLogic and RealPage tell us that housing prices are coming down. So there is a significant lag in there. I'm not going to belabor how they calculate that lag, but understand that there is. So let's just look and see whether these housing prices are still coming down, because this graph here I'm showing you is actually from late 2022. The quick answer to my question is yes, they are still coming down. In fact, here is a report from rent.com. This is as of April 2023. They take a monthly look at the rent prices, and a quick look at this graph will tell you that things are changing. In fact, if you follow the yellow line, this is the year-over-year line, you'll see that there is a steep decline going on when it comes to year-over-year in terms of percentage. We're going to finish our discussion for this video with the last question. Should I buy I bonds now with 0.9%? That sounds a little bit attractive, 0.9% fixed rate. Or should I hold out for something better? In order to help answer that question, I have actually plotted here the Fed funds rate versus the I bond fixed rate. I love graphs. I think they say so much more than words. Let's quickly take a look at what the data shows. 4.65% is what the federal funds rate is right now, and 0.9% is what the latest I bond fixed rate is. We'll go back to roughly 2007-2008 when the federal funds rate was similar, and we'll see that the I bond fixed rate was actually well above 1%, whereas now they've got us at 0.9%. So the Treasury's lowballing us a little bit here. Now, I haven't fully answered that question, should I hold out or should I buy now? I think the answer depends on whether you are in I bonds for the long term, 20 or 30 years, or whether you're just in this as a best place to park your cash sort of scenario, competing against Treasury bills, CDs, and even high yield savings accounts. If you're in I bonds for the long term, 0.9% is not too bad. Again, you actually have to go all the way back to 2007 to get a better rate. However, I actually think that you could hold out for just a little bit more, but you're not wrong to purchase now at 0.9%, I think. If I am in I bonds for the short term, no way am I buying now, because I think that 0% is highly likely when it comes November 1st, and your money would be earning 0% for 6 months, when you could have it in a Treasury bill, a CD, or a high-yield savings account, earning far more than that. I hope this information was helpful for you. Please give us a thumbs up, and we'd love to have you as a subscriber. Until next time, as always, enjoy your investing.